Welcome back, best ever listeners, to the Horizon Podcast. This week, I'm joined by John Manning, the Senior Vice President of Marcus & Millichap Capital Corporation and the head of the Western Division of the U.S. Marcus & Millichap Capital Corporation is a lender for commercial real estate. I had John on my podcast last January when we were both at NMHC, the NMHC Strategies Conference, and I thought it was about time to take another look at the lending climate. We're going to talk about who's lending, what the rates are doing, what investors can expect as they navigate the lending markets. We did a little bit of a dive into debt service coverage ratios, and we took a good look at CMBS as well and what the advantages and disadvantages of that are, as well as what's happening with the construction lending climate. So, good conversation to look forward to here. I'm John Chang, and I've been active in commercial real estate for most of my life. Since 2007, I've been leading the research and advisory services team at Marcus & Millichap, which is the leading commercial real estate brokerage company. Now, I must mention, as I do each week, that I'm doing this podcast independently, and what I say on the show doesn't reflect the opinions or positions of Marcus & Millichap. So I'm going to jump in with John here. All right, John. So what is happening in the current lending climate? What are you seeing out there?
Yeah, well, thanks for asking, John. It's great to be a guest on here again. It's nice to be back with you as always.
Yeah.
It's an interesting market out there. Certainly, what's nice is the balance sheets of the banks have been by and large repaired. They're not quite perfect right now, but they're still at a point where most banks, credit unions as well too, have reasonably repaired balance sheets and are out looking to lend on commercial real estate, generally speaking. So it's that part of the market, which is critical, and it's really critical for middle market and private client type borrowers, is kind of gradually come back. If anything, there's a little bit of a lack of transaction volume, and that probably slows down the overall level of activity. But writ large, it's better than it was last year, and it's certainly better than it was the year before. If you look at the other lending categories, and I guess we can kind of go through those, but one at a time if you want, John. But
sure.
The life insurance companies have great balance sheets. There's a lot of new players in that market as well, too. Many have been bought by these private equity firms, and they're becoming a little bit more aggressive. But regardless, there's a lot of kind of longer term capital out there available for borrowers on a non-recourse fixed rate basis. And the CMBS market, Wall Street money, if you will, financing commercial real estate assets, again, on a permanent basis, 10 years and candidly about 5 years now as well too. That market is very robust and having a big year, a much more so than last year and dramatically more than 2023.
So why is there so much more CMBS out there this year? Why are people going that way?
Yeah, good question, John. Good question. I think there's a confluence of reasons. One is that there are a series of large single asset securitizations, or SASBs as they're called, that have taken place. Another reason is that, with rates where they're at, I think maybe borrowers are getting a little bit more used to where we are, and that, the 4, as of this morning, John, I think we're 4.3 or 4.4 Treasury, 10-year fixed rate Treasury, is kind of the norm, right? And if you look back to, this stuff better than me, but if you look back to last, say, November or so what's that, eight months now, we've kind of been in a range that's reasonably right around that point. And if you look at the long-term historical norm, again, I'm sure you have a more thoughtful opinion on this than I do, but you look at the long-term inflation rate, you add the long-term growth rate, you get to 4%. These are kind of where rates ought to be. And borrowers are a little bit more likely to say, okay, I'll take that deal. I'll take that for 5 years, or I'll take that for 10 years. And with banks not maybe being 100% back in the market still, there's the nice thing about the CMBS world is the bond, those loans go onto the balance sheets of investment banks and commercial banks, candidly, as well too. But within those CMBS groups, and then they're securitized and taken off the balance sheet in the form of bonds, essentially, right? So as a result, there's long-term capital available there that the banks don't have, and people are just willing to just, lock rate and take those deals these days. And I think that's a big part of it. It's really the demand side more than the supply side.
But why would you pick a CMBS loan instead of getting a loan from a bank or an insurance company?
Well, different answers to the two. I'll start with insurance companies for a second.
Sure.
So the insurance company is going to lend you typically, it depends on the asset and so forth. They're going to lend you, they'll say 60 to 70%. A lot of times it's more like 50 to 60 or 65%. Again, depends on the asset, the cash flow, the newness, the qualities, and so forth. Their servicing will be much better than the CMBS lender. And they're a little bit more in the custom suit business. I mean, you want an 8.5-year deal with 27.3 years amortization, you can probably get it done. You can probably negotiate that, right? In the CMBS world, you cannot. However, that CMBS lender will truly get to 70% or, at times 75 or theoretically even 80 on apartments, right? So they'll lend more. They're a little bit less picky on that C quality apartment portfolio or that unanchored retail center or that hotel with the, flag you may not exactly want. There'll be going to be, that metal roofed industrial building. They're going to be a little bit easier on all that. They're going to provide full term IO in most cases now. I mean, that's become ubiquitous in the CMBS world, totally different than, 5 years ago or what have you. So you're willing to sacrifice kind of lousy servicing and the fact that you have to have either a 5-year deal or a 10-year deal and kind of a painful closing process and kind of an inability to lock rate until the day before you close. I mean, there's negatives in the CMBS world, but there's also positives. And, John, I haven't been in this business for, over a quarter century now with the gray hair to prove it. I will say that a lot of times borrowers will want a life company deal, and then you lay out the options for them when you get your quotes in, and the economics of the CMBS can be, in a lot of cases, much more compelling.
So they're offering generally higher leverage and interest only, which you're not going to get from an insurance company. What about a bank? Are the banks even competitive in that?
Yeah, banks are a little bit different space, right? Because the banks are generally doing, 3 to 5 year terms, whereas CMBS is 5 and 10 year. Now, where they overlap is in that 5-year space. So they probably do compete more now than they usually do because the CMBS is so aggressive in that 5-year space. We'll start with the obvious. Start with the biggest factors. Banks are recourse. So the borrower, generally speaking, is going to have to personally guarantee the loan. Now, there's exceptions to all this, but for the most part, that's the case. So the banks are not going to let you have that interest-only financing. And again, most banks are going to be a little bit more picky on asset quality than the CMBS lenders will. So it's really kind of that combination of reasons that make the CMBS. And look, the banks are bigger.
Right.
Look, the banks are doing more 5-year loans than CMBS is still, right? So it's not like the CMBS lenders are killing. But yes, the reason why someone would choose CMBS versus bank, and those are some of the reasons for that.
What about the GSEs, Fannie and Freddie versus CMBS loan?
Yeah, so Fannie and Freddie are having reasonably good years. They're trying to get to their production goals this year, and I think they're going to make it. We'll see.
Right.
It's naturally they're only lending on multifamily assets or occasionally mixed use with a small amount of retail and 8 stories of apartments above it, right? So they're limited to just the apartment sector, of course. But they're competitive right now. The GSEs, Fannie in particular, and also Freddie, are definitely out there competing on multifamily assets. They're fulfilling their charter, right, which is to create a liquid financing market for multifamily. So they'll go into those sort of secondary markets, a lot of suburban markets, the downtown pristine. Well, CBDs have their issues now, but let's just say by and large speaking, your Class A location, Class A asset. The life companies might beat the agencies on that, but they beat CMBS, every day of the week and twice on Sunday on multifamily assets. The ones that maybe the agencies won't do, like those Class C apartments, for example, or all IO or what have you, the CMBS lenders are starting to compete more on those multifamily deals. But by and large, for permanent, non-recourse multifamily financing, Fannie and Freddie, really, it's a two-horse race with those two players really dominating the field.
So what kind of rates are you looking at with Fannie and Freddie? Of course, there's a range and it depends, but
Sure.
kind of get a feel for it.
Yeah, 5.5% to call it 6.5%, generally speaking, with the agencies, John, is probably where you are. The life companies, are probably 5.25% to 6.25% type of range. And your CMBS guys are 650 to call it 750. So that's those are kind of their slots, if you will.
Yeah.
For deals.
So there's a huge range out there, and one of the things that even within each property type, there's a range. But which let's kind of run through the different property types. Let's start.
Sure.
Let's start with an outlier here. What about like self-storage? I know I'm throwing all sorts of curveballs at you, but
yeah, it's all right. It's all right. It's all right. No, it's all good. So storage is well thought of in the lending community for a variety of reasons. That's probably been the case, John, for a solid decade or so now.
Mm-hmm.
Look, you have granular rent rolls for starters, right? So it's not like an office building or Lord knows a mall where there's an anchor tenant that if you lose, the whole thing could, kind of go sideways, right? So not the case there. I would say that the space is not really overbuilt. There was a period of that after the GFC where there was a lot of sprawl suburbs built and the self-storage developers came in after them, but that's no longer the case. So you have granular rent rolls. You have, management's important, but it's not a hotel either, right? Where the flag is so critical, the management company is so critical. So it's a well thought of category. The life insurance companies love them now, John. I mean, that's very different than a decade or more ago. The banks like them as well too. I can't think. You'd be hard pressed to find a lender category that doesn't want to do self storage deals.
So what kind of rates are they looking at?
Yeah, I would say the ranges we were just talking about there, the life cos, they're probably in the 5s most of the time. I would say with the conduit lenders, they're probably in the 6s. And again, that would be your little bit higher leverage, your a little bit older product, you're a little bit maybe borrowers that aren't quite as strong. And the banks pricing wise, somewhere in between. The banks will be recourse, but again, their documents will be more flexible. Their prepayment penalties, I skipped over that. The prepayment penalties with the banks are far more flexible than they are with the other lender categories as well too. So the banks could be a good source, particularly for smaller transactions, which a lot of self-storage facilities are, right? There's a lot of $5 million loans out there in storage.
Yeah.
I mean, that's one of the issues, like the life companies, like they want to do more storage, but you have to find a big portfolio from some big institutional owner to get to your target, basically, right? And there's not that many of them out there.
Yeah.
So
what's the minimum threshold on the insurance companies? What would you say they're not willing to play unless it's over whatever? What?
A few $1 million, probably 3, something like that. I would say, yeah. The CMBS maybe a little bit more. I mean, the CMBS will do that, the $5 million deal. It's just that the transaction costs are so high that borrowers sometimes just don't want to.
Okay, so wait, the transaction costs. So CMBS has higher transaction costs than you're looking at with some of the other lender options?
Yeah, you can get to a $20,000 to $40,000 legal bill pretty quickly sometimes, right? But that could be 1% of your loan, right?
Yeah.
Just that alone, right? So a little bit more likely to have a little bit more stringent requirements, and just in terms of reporting, in certain situations they'll want don't want to get too far down the legal rabbit hole, but Delaware LLCs that are bankruptcy remote. So there's a lot of structuring of that type involved, which is a challenge. And then you can also, you're not locking rate until the day of close or the day before close with CMBS lenders for the most part. So that's another
that's a big
challenge.
variable. Especially in a choppy climate. Although, I guess rates have been bouncing around between 4.25% and 4.5%. Like you said, for since November of last year, basically.
Right. But keep in mind, a lot of loans are can be DSCR constrained, right? So, if you have a full loan, and then rates pop up, 20, 30 basis points. If it's an acquisition, you might not like your purchase price. Refinances are different, but on an acquisition loan, a lot of borrowers really want to lock in their rate as soon as they possibly can.
Yeah.
Take that risk off the table.
So you mentioned the DSCR, debt service coverage ratio. Explain how that works, just in case some people aren't up to speed on that.
Sure. So a debt service, loans are constrained by loan to value, and that's how we usually talk about that, right? So you're, up to 80% on apartments, or maybe up to 75% on good retail centers, maybe self-storage. You're 70% or 65%, say, on hotels, industrial, like those are your kind of LTVs. Debt service coverage ratio is you're underwritten by the lender, net operating income on the property, often less some kind of reserve requirement. That number, so call it your income on the property. And remember, that's the lender's income on the property.
That's what they're counting. Right.
Correct.
Yeah.
So, if your insurance bill, they think it's a little low, they might round that number up a little bit, for example, right? So things like that, right? If your property is 3% vacancy, but the market is 8% vacancy, they're going to underwrite 8% vacancy, right? So it's going to be lender's NOI. So lender's NOI, which again, probably a little less than the confident buyer, if you will, or confident owner. That number divided by your debt service, your mortgage payment, your annualized mortgage payment. And that has to be, typically 120 for apartments and 125, call it, for commercial property. It varies by lender category. And maybe it's a little bit higher for hotels, 130, 135 type of number. So you want, the lender wants some cushion, right? If there's a bad month or two in your apartment complex and a bunch of people move out for whatever reason, they want to make sure that there's still enough income coming off the property to pay the mortgage. So they kind of want a 1-2 in the case of apartments, which are lower risk because that's less likely to happen there, right? But they'll want 1.2 sort of debt service coverage ratio to make sure that there's cash flow to pay the mortgage.
So basically, they want your income to be 20 to 40% higher than the debt payments for the year.
Exactly.
Got it.
Okay.
Last January, when we were talking at NMHC, we were seeing a lot of private lenders get into the space, and it was pressuring the spreads, and they were tightening up the lender spreads at that time. What's happened since then?
I'll tell you the area. The one lender category we haven't touched on are debt funds. Mm-hmm. And so debt funds are their spreads that's become an exceptionally competitive market. One of our top originators here just put together a list of 360 debt funds that are active in across most all of which have a national platform. I mean, the amount of debt funds available, it's just shocking. And they'll do everything from the smallest deals to the $720 million transaction we closed in Manhattan earlier this year. Debt funds are prolific, and debt funds basically do bridge loans that are non-recourse. So basically, what your debt fund is doing is lending you priced over SOFR, which is the new term for LIBOR, right? Which is like 434, I believe, as of the other day. They'll lend you that plus a spread over it, and that spread, to answer your question, now can be as low as in the mid to even low twos for the most competitive, clean multifamily deals. up to, it could be 4 or 5 if you have a, condo construction loan or hotel construction loan. It could be a very high spread. But they're lending you at SOFR plus that spread, typically 3 years, sometimes 4, sometimes 5, but usually it's a 3-year loan. It's to get you through some type of repositioning. So maybe it's a lease up of a new apartment complex. Maybe it's a bridge loan where you're buying a new retail center. You're going to fix it up, get the cash flow up, and then sell it. Maybe it's a construction loan even, right?
Right.
A lot of these debt funds do construction loans. Not most, but quite a few. We'll do construction loans as well too. So they're generally non-recourse. They're floating rate. There's no prepayment penalty. They're good at funding additional draws if needed. So if you're buying that apartment complex for $30 million and you're going to put another $5 million into it, they'll give you that $5 million, right? They'll provide those extra dollars for you to fix up your property, and they'll have the flexibility for you to sell it at the end without any kind of a prepayment penalty. So they're great lenders for that type of situation. And they're prolific right now. There's a bunch of them out there. And because there's so many participants, they're really competing all for, they're competing on deals. And those spreads have just come in.
Wow. So you mentioned construction loans. One of the things I've been talking about a lot lately is the drawdown in construction. Some of the points I've been making is, look, tariffs are going to impact construction, immigration policy is going to impact construction. But one of the things that really slowed down the construction market was access to construction financing and the cost of construction financing. So, what's that looking like these days?
It's tough. It's tough. I mean, I would say most construction loans, again, with the SOFR short-term index, right, at 430, call it. Now that may go down. The market shows that going down a little bit here in the next bit of time until, as the Fed drops rates. So those numbers likely are maybe it comes down 50 basis points, 75 basis points over the next year or so. But still, you're based over that 430 type of number. I don't know, 4%, 4% or more spread. So you're talking about, 8 to 9%. Yeah, it's John, it's hard to make the numbers work. It's hard to make the numbers work. You're building an apartment complex to a 6.5 or even close to 7 return on cost. If you're borrowing at, 8.5%, 9%, it's hard to make the numbers work, basically. So it can be challenging. As you well know, there's not a lot of construction loan demand right now because there's not a lot of assets breaking ground, right?
Right.
With the increase in construction costs and kind of lack of capital flows into that space. Having said that, we closed a $60 million. Can I break some news?
Yeah, sure.
We closed a $60 million construction loan in Southern California on a multifamily asset this morning.
Fantastic.
So good news.
So Southern California, that'll be done in 4 or 5 years?
No. It's breaking ground. The asset's breaking ground. It probably took that long to get entitled. I have to go ask one of our top originators down there. He just got that over the finish line. So
there's all these different types of lenders, and a lot of people just say, well, I have a relationship with my bank. So I heard a number the other day, but I don't remember exactly what it was. How many different lenders is MMCC working with? How many did they work with last year?
In a typical year, we're going to close with 400 lenders, as many as, 450 lenders in a year. 375-ish last year. I mean, we're just, we cover the market wide for our clients. We close with as many lenders as any intermediary. Part of that's because of the granular nature of our firm, right? So if you're buying a strip center in Alabama, we'll get that deal done for you. And we know the banks in, every nook and cranny in the country.
Yeah.
So working with an originator is pretty common. Even the most sophisticated institutional borrowers use intermediaries like ourselves. Now, in our world, they'd be more likely to use our IPA capital markets team than MMCC or Market Small Cap Capital Corporation platform for those transactions. But that's a large chunk of our business, by the way. But if you come to an intermediary such as ourselves, and we think we're as good as anyone, we'll get your deal out to 70 lenders, right? And the most experienced brand name major developers, they just don't have that platform. They may do 5 or 8 deals a year. We're going to close 1,200 plus in a year, 1,400 in a year, 2,000 in a year, right? So it's just a different scale. The reach that we have is just completely different than really any borrower can have. So there's a big value add factor for us.
So by going through somebody like you guys, you're basically able to access a broader pool of lenders, and so you get you're truly looking at the whole market as opposed to, hey, I'm just going to go down to my bank. I do deals with them all the time.
Sure.
And you're going to get whatever they have that day.
Yeah.
And that might be better, right? That local bank that you've done business with over and over, that might be the best deal, but it might not.
It might end up being the best deal at the end, actually, when you're out.
Yeah.
Like for John, I'll see you in Vegas, right? In a what is it, 6 weeks or so now at the Western States MBA. I think you're not the keynote speaker. You're one of the lead speakers there.
Yeah.
We're going to have 60 lender meetings live there. 60. That's a little regional conference. You have our national MBA, that conference. And I'm not talking about casual meetings where one of our guys meets, the head of, some big lending group in a bar for a drink. I'm not counting 1,000 of those, but we will have, 200 plus, in-person lender meetings where they're coming to us, pitching their wares. No borrower has that reach. Right. And we'll also have our we also have our fingers on the pulse, like what the hot button issues are at the moment, where spreads are, how you get around a certain issue, on a zoning report or what have you. Like we just have so much volume of business that our reach is just dramatic. It's like if you're selling an asset, right? If you were selling a retail center in Scottsdale, John, your hometown, right? Look, if I were selling a retail center in Scottsdale, I owned one, I could probably figure out who owns, 5 or so of the retail centers around and, hop on the phone and call and get 5 people to maybe take a quick look at it. Or I could hire a broker and they could put a package together and they can go out to, hundreds of potential buyers. Right. And it's the same thing on the financing side, right? If you're financing a retail center in Scottsdale, you can look around, you can talk to your local bank. But particularly as you get away from the banking side, our reach is, it's really hard for borrowers to know who the players in the market are and who's going to be the most competitive source. The vast majority of times we're closing deals for clients with lenders they've never closed with before.
Right.
We get platforms that they're not familiar with. So it's a different world, and thus we're able to add a lot of value for our clients.
That's cool. So, all right. So we got 4 or 5 minutes left. Let's shift over to the horizon. Let's look forward. Yeah. Doesn't it go fast? It goes fast when we get into these conversations.
Too fast. Get warmed up.
Yeah. So looking forward.
I got to go to the airport when we're done too. So I'd rather keep talking to you than go, wait in line at TSA, John. So,
so looking forward, what's ahead? If you're looking, actually, let's reverse it. 5 years from now, it's 2030, and you're looking back at 2025.
Yeah.
What's that look like? What do you wish you had done more of? What are the challenges? What do you see looking back on today from 5 years from now?
Well, I think when you're looking at 5 years from now, you're going to look back at now like, wow, it's just starting to come back. The business, the transaction volume is just starting to come back. And our business has it's been a tough 3 years for our industry, John, in a lot of ways, right?
Yeah.
The interest rate shock, which that's spoken about quite a bit on your podcast, the episode, including episodes I've listened to, which is most of them. So look, I think if you look back 5 years from now, you'll see a world with a lot more volume than we have now. I don't know if that's double or triple or 70% more. I don't know the number, but I think you'll be at a time where there'll just be a lot more transaction volume. I think the capital flows into real estate, which was touched on actually you touched on, John, in a recent podcast. The capital flows into real estate could be, materially more, both from institutions as well as from private clients, particularly, some of the legislation that they're talking about allowing mom and pops to use their retirement accounts essentially to get into the sector in a little bit more easier fashion.
Yeah.
So I think you have a lot more transaction flow and thus a lot more volume in the debt space. I think that will be the biggest difference. Look, I don't know if, interest rates, I don't have a crystal ball. If I did, we'd be, we'd be off on our jet to some island somewhere, right? But, so I don't necessarily think interest rates change so much as capital flows change, and there'll just be a lot more volume in our space. And I think people will be looking back at now as those were the tough years and, just kind of getting out of it essentially.
So do you think we're at a turning point? Is the market starting to shift?
I think we've turned, but I feel more like it's a battleship turning around in the ocean than it is, like an inflection point per se.
Yeah, it's not a bounce.
Yeah.
It's a turn. Yeah. We're starting to pick it up.
Exactly. I mean, who knows? Maybe we're all going to wake up someday. Blackstone will have acquired some, major public REIT, and everyone will say, "Oh my God, the biggest money, Brookfield, or whoever, and everything will turn on a dime, or there'll be an inflection point." I'm not sure that inflection point happens or doesn't happen, but I do think time cures all wounds, right? And the wound from the interest rate shock, I think, is curing. I really do. It's a functioning market out there. Look, your deal can get financed. That's what I'll say, right?
Yeah.
There are multiple bids on every loan that we have. Every loan assignment that we have, really almost, if not entirely, without exception, there are multiple lenders quoting. So I think when you look back 5 years from now, you'll say, yeah, the market's starting to repair itself, but it's not as good as it is today here in 2020,
or 2030.
2030. Yeah.
Yeah. So, just looking at sales activity, volume is picking up, deals are getting done, lending is available, liquidity is pretty good overall.
Yeah.
Rates are higher than people like.
Yeah.
But historically speaking, they're about normal.
Yeah, that's right. I mean, John, what do you think things will look like 5 years? Let me flip it back to you for a second, because you're more time and intelligently thinking about that than I probably do.
So one of the things I dug up was that in the last 35 years, cap rates have only gone up 4 times. We're in the fourth sequence where cap rates have gone up, and inevitably they go back down. I think that there are a lot of forces that are starting to stack up to boost market liquidity. The lending climate is healthy. The transaction market is reasonably healthy. The flow of capital into commercial real estate is increasing in general. Toss out 21 and 22; those were aberrations. But we could get to that level of activity again over the next few years, especially if this executive order gets signed and people are able to move money in their 401ks into real estate more easily. I think that the flow of capital into the market could rise, and I think that that's going to put downward pressure on cap rate, which fuels additional capital coming into the market. And I think that we're really at the market is starting to turn, and I think it could pick up again over the next couple of years and get aggressive. But it varies by property type. I think office is kind of the laggard and has the most room to grow. And it's starting to turn, but each property type, each market's going to face its own nuances. If you're talking about Austin multifamily, you got a little bit longer to go because of the overdevelopment. But nonetheless, I think the whole market is turning, literally now. And so, I'm just happy that the lending climate is so liquid and there's access to the debt capital at reasonable rates.
don't you think that anybody breaking ground right now is going to look really smart in a few years? I mean, and take away your southern part of Austin or what have you, and a few niche markets here or there.
So yes and no, right? So on one hand, if you can make the math work and you're bringing the units online as we get into a period where there's very little new supply, that works. But the hard part is, how do you finance it?
Right.
How do you pay for it? How do you find the labor for it? How do you bring in, steel I-beams at a 50% tariff and make the math work on the materials?
Yeah.
So that's the hard part. If you could sit down and do all the math and figure out, okay, yeah, I could get all my materials and I have my labor sourced and I have my financing and the math still works, then yeah, it's a home run. If you're coming online in 2 years, I think that's right in the middle of the big slump in development.
Yeah. But to your point, right? That if the debt is 65%, so say 2/3 of your money for a development project is that construction loan we're talking about at 8.5%, and the other 1/3 is an equity partner who wants 18 IRR, something like that, right? And then you add in, costs are up 8%, 10% because of whatever tariffs and everything else going on. Then there's
but you have to plan for those to go up even more.
Exactly.
Right? Because those tariffs haven't materialized yet. So you have to plan that the cost of the screws and the nuts and bolts and the doorknobs and the appliances, if you have them, and concrete, all of those are going up and they're not here yet. So you have to plan for those to go up even more than they are today.
Agreed. Yeah. And there's an ICE rate on your site too, by the way. So your labor costs are going to go up as well, right? So everything can happen. You have a 10% bust. And I agree with you.
So it's hard to make it work and it's hard to make the math work.
Yeah.
But if you can, then you're going to be coming in at a time when nobody else is building and there's opportunity there.
Yeah. Yeah. So. You're competing against no one.
Yeah. All right, John. We're going to wrap it up here. It's a great conversation, and I truly appreciate your joining me. And good luck at the airport today.
Thanks, John. We'll keep my fingers crossed for a safe and on-time flight.
Yeah, perfect. No events at all. Perfect.
Exactly.
All right. Awesome. Cheers. I'll see you later.
Take care.
Bye. And there you go, best ever listeners. Thank you so much, John Manning, for taking time out of your day to join me for this conversation. And I want to thank all of you for listening to the Horizon podcast with me today. I'll be back next Sunday and every Sunday with real estate insights to help you understand what's really going on in commercial real estate.